Welcome back to the deep dive. Today, we're really getting into a tough one. We're looking at the collapse of XUSD.
Yeah, the stablecoin from Stream Finance.
Mhm.
It wasn't just a slip, it was a brutal implosion,
Yeah.
swift and, well, painful for a lot of people.
Absolutely. It went from a dollar peg straight down, what was it? $1.30.
Initially, yeah. Then it slid even further, bottoming out around 0.26 cents. A catastrophic loss, something like 77%.
So for you listening, our mission here is to unpack why. We're going through the source material to understand the layers here, the hidden leverage, the opaque operations.
And the systemic risks that just piled up.
Yeah.
We want to show how a stablecoin, which is supposed to be, well, stable, could just vanish like that.
Okay, let's start with the trigger. The headline news was a huge loss, right?
That's right. Stream suddenly announced a $93 million loss. They pointed the finger at an external fund manager.
And that immediately led to them freezing funds.
Yep, $160 million in user funds just locked up instantly.
Wow. And the timing couldn't have been worse, could it? This was right after another major incident.
Exactly. The balancer protocol exploit, a $100 million hit, had just happened. So the market was already incredibly anxious, jittery.
So when Stream showed weakness,
People ran for the exits. Fast. It triggered this massive cascade of withdrawals that just couldn't be stopped. The context really amplified the whole thing.
okay, so let's dig into the structure itself, because it seems like the foundations were shaky from the start. The numbers just didn't seem to line up.
That's the critical point, really, the discrepancy. Stream was advertising, quite loudly, a total value locked TVL of $520 million.
520 million, that's the number they were showing everyone to build confidence.
Right. But when independent platforms actually looked on-chain at the verifiable deposits,
What did they find?
only $160 million.
160. So where was the other $360 million? That's a massive gap.
It's a black hole. And what it tells you, really, is that Stream wasn't just a stablecoin protocol.
Yeah.
Not really.
What was it then?
It was essentially operating like a tokenized hedge fund, highly leveraged, using proprietary strategies mostly off-chain.
So hidden leverage of what? More than 4x the actual user deposits?
Easily. And those funds were going into strategies that users had absolutely zero visibility into. Completely opaque.
Which completely contradicts their marketing. Right. They kept saying they were delta neutral.
They did.
Yeah.
And, delta neutral implies a strategy focused on managing risk, offsetting positions to avoid big swings. Theoretically, it shouldn't lose money dramatically like this.
But that wasn't the reality here.
Not even close. They weren't managing risk. They were chasing yield aggressively, using high-leverage recursive strategies, promising these big returns, like 12% across maybe 50 different pools.
And community investigators suspected.
They suspected, and it seems they were right, that customer assets weren't just backing the stablecoin. They were being used as fuel to amplify the risk, to make these huge leveraged bets.
So if the public numbers were off, and the stated strategy was, well, a lie, what were they actually doing with all that money off-chain?
This leads us to the core strategy, the really risky one they were apparently running behind the scenes. It's often called selling volatility. Short vol.
Selling volatility. Okay, explain that. It sounds like betting on things staying calm.
Pretty much. You profit when the market is stable or volatility is low. You collect the premium from selling options, basically.
Yeah.
Small, steady income when things are quiet.
But there's a catch. A big one. You mentioned an analogy.
Yeah, it's a classic one in finance. It's like picking up pennies in front of a steamroller.
Picking up pennies, okay.
You make small, consistent gains, picking up those pennies. But if that steamroller, a sudden, massive surge in volatility comes along.
You get flattened.
Completely. The losses could be enormous, catastrophic, wipes out all the small gains instantly. They were essentially trading the risk of total failure for a bit of steady income.
And that steamroller eventually hit. What was the trigger? What caused that kind of volatility spike?
It was an external shock. Macroeconomic news. The sources point to the market chaos around new tariff policies, specifically Trump's tariffs. It happened on what people started calling Red Friday back in October 2025.
Red Friday, and that caused
A huge decade-level spike in volatility across global markets. It wasn't just crypto, it was everywhere.
So that shockwave just ripped through the crypto market, exposing all the leverage.
Absolutely. Strategies that looked fine before, even with moderate leverage like 2x, were getting liquidated left and right.
And for Stream, running this short vol strategy with massive hidden leverage.
They were ground zero. As one source put it, they were the first corpse to surface. Their collapse showed just how fragile the whole leverage system had become.
Wow. Okay, so the collapse itself then exposed this tangled web of debt across DeFi. How did they amplify their own risk internally? You mentioned recursive borrowing.
Right, recursive borrowing. It's a way to maximize your exposure using the same collateral over and over again.
How does that work practically?
Well, imagine you deposit $100. You borrow, say, $70 against it. Then you deposit that $70 back into the system and borrow against it again, maybe $50 this time.
Ah, okay, so you keep looping the borrowed funds back in.
Exactly. You're borrowing from yourself, effectively. It multiplies your capital exposure without adding any new outside money.
Which means you're also multiplying your risk exposure to whatever bet you're making. If that initial $100 goes bad.
Your losses are magnified across all those loops. You could owe way more than your initial deposit.
And Stream was doing this heavily.
Very heavily. Their own internal wallet reportedly held something like 60% of all the circulating XUSD. And that was all leveraged, including a huge $95 million position on lending platforms like Plasma Euler.
So when their main debt collapsed, this internal leverage meant the contagion was instant.
Instant and widespread. Researchers quickly identified almost $285 million in direct debt exposure just on major lending protocols: Euler, Silo, Morpho, Gearbox.
But it went beyond just direct debt, right? There's indirect exposure too.
Oh yeah, much more complex. This is where you hear terms like rehypothecation chains.
Okay, that sounds complicated. What does that mean in this context? How does reusing collateral spread the failure?
It means other protocols were using Stream's XUSD as collateral for their own assets or stablecoins. So when XUSD collapsed, their backing collapsed too.
Like dominoes.
Exactly.
Yeah.
Take Elixir's DUSD stablecoin. They had lent $68 million in actual USDC to Stream. That $68 million turned out to be 65%, almost two-thirds of the entire backing for DUSD.
65%. Wow.
Yeah. And then you had others like Treve's CUSD exposed because the collateral was tangled up in these chains where the same asset gets pledged, borrowed against, pledged again somewhere else. When Stream broke, the whole chain fractured.
This whole situation screams lack of transparency, which brings us to another controversy, this alleged insurance fund.
Right. During the collapse, accusations flew that Stream had been secretly siphoning off profits into an undisclosed insurance fund. One user even claimed they were taking a hidden 60% fee.
Did Stream admit to this?
They admitted a severe lack of transparency about it. They kind of argued that, well, internally they always intended it to be an insurance fund. But intention doesn't really help when users discover it during a crisis, you know?
No, it just fuels panic and mistrust. It confirms the black box fears.
Precisely. And that lack of transparency, that feeling of hidden dealings, ties directly into maybe the most controversial part of this whole mess.
Settlement seniority.
Ah, yes, Elixir. The protocol that lent Stream the $68 million, they claimed seniority.
They did. They came out and said they had an off-chain private agreement with Stream that gave them settlement seniority.
Off-chain? Private? What does that mean for everyone else?
It means Elixir got to cut the line. They could reclaim their principal, their $68 million, first, at the full $1 value per USDC before other XUSD holders got anything.
So they get paid back in full, while regular DeFi users holding XUSD are left with pennies on the dollar. That's essentially it. The losses from Stream's risky, hidden bets were socialized, dumped onto ordinary users, while the institutional player with the private deal got preferential treatment.
That feels like a massive betrayal of the DeFi ethos. Code is law, unless there's a private handshake somewhere.
It really challenges that core premise, doesn't it?
Yeah.
If off-chain deals dictate who gets paid first in a collapse, then your on-chain balance isn't the whole story. It undermines the idea of transparent, equal rules.
This is clearly unsustainable. You mentioned, what, $3 billion in DeFi losses this year alone? Things like this can't keep happening.
They can't. And the sources argue they are preventable.
Yeah.
But it requires moving beyond just trusting projects' marketing. We need better tools for verification.
So what's the path forward? The sources mention a potential solution.
Yeah, a framework proposed by a team called Trading Strategy. They introduced something called the Vault Technical Risk Score.
Okay, a technical risk score. How does that help? What's it measuring?
It's focused specifically on the technical execution risk, not market risk, like whether Bitcoin goes up or down.
Right. So not predicting market movements.
No. It's about the engineering quality, the operational purity. How likely are you to lose funds because of a bug in the smart contract, or an Oracle problem, or a flaw in the code? The technical integrity of the vault itself.
So it aims to give users transparent, verifiable data on how well-built and secure the platform itself is, regardless of the trading strategy risk.
Exactly. The idea is that even if a strategy is high risk, you should know if the technical foundation is solid or shaky. It helps distinguish good vaults from bad vaults based on measurable technical factors.
And the hope is that capital will flow towards the more robust, transparent projects.
That's the goal. Provide the information, let users make informed decisions, and hopefully starve the opaque, poorly built operations of capital. Force better practices through transparency.
It really brings us back to that fundamental lesson from all this, doesn't it?
It does. It's a truth that applies everywhere in finance, maybe even more so in DeFi. Quoting the analysis directly, the rule of high risk, high reward always holds true, but to apply it, you must truly understand the risks.
And with XUSD, users saw the promised reward, that 12% APY.
But the real risks, the crazy leverage, the hidden strategies, the off-chain deals giving seniority, those were completely obscured, hidden in that black box.
So stream finance was this perfect storm. Opaque management, hidden leverage, risky off-chain bets, all detonated by a market volatility spike.
Yeah, and it starkly highlights this tension in DeFi. The promise is transparency, verification, don't trust, verify. But then you have incidents like this.
Where secret off-chain deals and hidden operations are driving everything.
Exactly. A project can operate like a black box, allocate funds secretly, give private seniority deals. It makes you question the whole structure.
Which leaves us with a pretty sharp question for you, the listener, to think about. If a project relies on data you can't verify, if its core risks are hidden off-chain where you have zero visibility, how can you really know your capital is safe?
Does the current market truly reward verification? Or does opacity still hold an advantage? That's the challenge Stream's collapse forces us all to confront.